Okay, we're going to do problem PA2-2. This is on page 87 in your textbook, and is also the first problem in the Chapter 2 practice problems in Connect. Okay, it says here Deliberate Speed Corporation was incorporated as a private company. The company's accounts included the following at June 30th. Okay, here's all the account balances at June 30th. They want us to record transactions for the month of July, and the first thing they want us to do is to do the transaction analysis here. So let's take a look at the transactions. We issued 4,000 shares of common stock for $400,000 in cash. Okay, so picture the transaction happening. You're receiving cash and you're giving stock. Every transaction has at least two effects. It's called the duality of effects. It affects at least two accounts. And after that transaction is recorded in the accounting equation, it has to stay in balance. So cash is increasing here, and common stock is also increasing. By the way, in this case, they put the beginning balances in here, but later on for the T accounts, you're going to have to put the beginning balances in there. In B, we borrowed $100,000 in cash from a bank, and it's payable in 2 years. Okay. Anytime you have borrowings, they're usually done through loans or note payable. In this case, it's going to be notes payable. A note that is due more than 1 year into the future is considered a long-term note. Okay, so if we picture what's happening, we're receiving cash, we're signing a note and promising to pay. That's what we're giving. So our cash increases $400,000, and our notes payable increases for $100,000. In item C, we bought a building, an economic resource, an asset, $182,000. That's what we're receiving. What did we give? Well, we had to pay cash, $82,000, and we signed a long-term note. If it's longer than a year, it's a long-term note. So we gave up two things. So our buildings are going to increase by $182,000. Our cash is going to go down because we paid it out for $82,000. Oops, and I forgot to put a minus sign there. It says enter any decreases with a minus sign. And then our debt is going to increase. Now, if you'll notice, after I enter each transaction, the accounting equation stayed in balance. $400,000 here on the left side equals $400,000 on the right. In this case, in B, $100,000 on the left equals $100,000 on the right. In C, 182 minus 82 is 100,000 on the left and 100,000 on the right. The accounting equation stays in balance after every transaction. Okay, in D, we paid cash and we received equipment. Okay, so the equipment is increasing by 200,000, and the cash is decreasing because we paid it out, minus 200. This is an example of a transaction that affected only the left side of the accounting equation. One account went up, the other account went down by the same amount, so it has a zero effect. The right side also has a zero effect. In E, we purchase supplies on credit, on account. So we're receiving supplies, we're promising to pay later. So supplies is going up by 30,000, and so is our debt going up by 30,000. If we total down, including the beginning balances, cash totals $254,000, supplies $37,000, building $282,000, equipment $318,000, and a land $200,000. Accounts payable totals $50,000, notes payable $202,000, common stock $580,000, and retained earnings $259,000. Now, if we total all the assets, it would be $1,091,000. The liabilities $252,000 plus the equity would equal the right side added together would also equal $1,091,000. Now we have to do our journal entries. Proper journal entry format is that we first enter the date, then the account to be debited on the first line with the amount on the debit side, the account to be credited on the second line with the amount on the credit side. If there were more than one debit or credit, we would list all the debits first, then all the credits, and the total amount of debits in dollars must equal the total amount of credits. Every journal entry has to have at least one debit and at least one credit. There's no such thing as a one-line journal entry. And if there's more than one debit or credit, which we'll see in item C, then the total debits must equal the total credits. Okay, quick review on the rules of debit and crediting. We use the accounting equation as our example. Assets are on the left side of this equal sign, the left side of the equation, so we increase on the left side. Liabilities and stockholders' equity are on the right side of the equation, so we increase on the right side or the credit side. What if something decreases? We just do the opposite. We credit assets and we debit liabilities and equity accounts. Okay, for the first transaction, it says that we issued 4,000 shares of stock for $400,000. Okay, so we received cash. Cash is increasing. We record increases of assets on the left side because assets are on the left side of the equation. The left side is the debit side, so we'll put cash here, and we'll put, oh dear, it disappeared, cash with $400,000. Common stock is an equity account on the right side of the accounting equation, so we're going to increase on the right side or the credit side. So we have at least one debit, at least one credit, they equal, we record. The next transaction, we borrowed cash and we're going to pay in 2 years. If we look at our transaction here, we're increasing our cash, we're increasing our liabilities. Assets are on the left side of the equation, so we increase on the debit or left side. Liabilities are on the right side of the equation, so we increase on the credit or the right side. So now we'll debit cash. Oops, sorry. For $100,000. And we'll credit note payable long term because it's longer than a year into the future. So we have our debit on the first line and the amount in the debit column, credit on the second line, amount in the credit column, the total debits equal the total credits. Third transaction, and this is an example of a compound entry because there's going to be more than one debit or credit. In this case, we have, if we look back at our analysis, one asset increasing, the other asset decreasing. The net effect on the assets is $100,000. Notes payable is also increasing $100,000. So let's record it. Assets are on the left side of the equation, so we increase by left siding or debiting by $182,000. Remember, the account to be debited always goes on the first line. So we will debit buildings for $182,000, the full amount. But cash is decreasing. That's also an asset. We don't want to debit, that will increase. So we're going to credit to decrease, do just the opposite, $82,000. Liabilities are on the right side of the accounting equation, so we're going to credit or right side to increase the liabilities. Okay, so this is an example of a compound journal entry, more than one debit or credit. If this is the case, the total debits must equal the total credits, and they do. Both are $182,000. In transaction D, we've got a payment of cash to buy equipment. We have one asset increasing, the other decreasing. Okay. Assets are on the left side of the equation, so we left side or debit to increase assets. So we're going to debit equipment to increase it. What do we do to decrease assets? We credit. We do the opposite. So in our journal entry, debit equipment, credit cash, both for $200,000. Every journal entry has at least one debit, at least one credit. Last transaction, we bought supplies on credit. Okay. If we look back at our analysis, supplies is an asset. Supplies are increasing. Liabilities, or accounts payable is a liability, they're increasing. Okay, the rules of debit and credit say assets are on the left side of the equation, so we increase on the left side, or debit side. So we're going to debit and list supplies on the first line. Liabilities are on the right side of that equal sign, so we're going to increase on the right side, or credit side. So that goes on the second line, both for $30,000. So debit supplies, credit, accounts payable, $30,000. Remember, accounts payable means we have to pay both. The word accounts means on credit. Accounts payable means that we're going to have to pay it in the future. Accounts receivable, that would be an asset, would mean we would be receiving it in the future. Okay. Our next step is to enter in the beginning balances of all the accounts. Because we're going to we just journalized. We performed journal entries or created journal entries here. We now have to post to the ledger T accounts. Because we've journalized and recorded the entire transaction, we, however, don't know what the individual account balances are. We need to know that. So we're going to post those transactions to the T accounts. We start by entering in the beginning balances, which we have from leftover from June. So these must now be entered. So I'm going to do that quickly here for you. Okay, cash as a beginning balance, $36,000. Supplies was $7,000. Equipment was $118,000. And buildings was $100,000. Now, how did I know to put them on the left side? Well, the normal balance of any account is the side that you'd increase it on. So since we increase assets on the left or debit side, that's the normal balance of asset accounts. Okay, now accounts payable, liabilities, and equity, we increase on the right side, so their normal balance will be right side balances or credit balances. And again, I'm getting all this information from above. And retained earnings, $259. Okay, now let's post our transactions. And I may not have time to do all these with you, but at least you'll have a little bit of an idea how to do this and connect. Okay, so we're going to go to the cash account and put on the debit or the left side $400,000. There's the left side. You have to choose a transaction letter here, A. Then our journal entry says go to the common stock account and put $400,000 on the credit or the right side. Let's see, am I missing one? Missing one there. Okay, and again, choose letter A. Normally in the real world, we would be using dates. Now in transaction B, it says go to cash and put $100,000 on the debit or the left side. We're following the directions of our journal entries. Go to notes payable and put $100,000 on the credit or the right side. Oh dear, I'm having trouble now navigating. Okay, in transaction C, we go to buildings and put $182,000 on the debit side, cash $82,000, and notes payable $100,000 on the credit sides. I apologize, I'm having a little bit of trouble navigating here. Okay, so for buildings, we go to the debit side. That would be transaction C. Put $182,000 on the left side. And then we go to cash. Transaction C. Don't start with the top line because that's for the beginning balances. $82,000 on the credit side and notes payable. Transaction C. Also on the credit side. Now notice how Connect has been calculating these balances for us. Makes it a little bit easier, doesn't it? Okay, now in transaction D, we go to equipment, put $200,000 on the debit or left side, then cash, put $200,000 on the credit or the right side. Okay, let's see, here's equipment, transaction D, $200,000 on the debit or left side and notes payable, transaction D, $200,000 on the right side. Finally, supplies, we debit that for $300,000 and accounts payable, right side or credit for $30,000. So supplies, transaction E, and accounts payable, transaction E.